Steve Misener joins me now, chartered financial analyst extraordinaire, man about town, bon vivant. Steve, how are you?
I'm good, James. How are you doing?
I'm doing well, Steve. Now, you have pretty good depth of expertise in looking at the commodities, the currencies from the global perspective and what that means for our economy going forward. Let's start the conversation with a look at currencies. What's going on with the US dollar relative to all of the other ones?
Well, the dollar has been in a rising trend of late. It's trading around 97 on the trade-weighted dollar base or the core dollar index. But I think there's been a bit of a battle. I mean, people were buying it because it had the strongest economy in the world, and it may still, although we're seeing some slowdown in the first quarter. Also because the Fed had previously, up until meetings of a week or two ago, they had been indicating a continued trend of rising rates and leading the world. That made the currency more attractive for investors to be buying into a currency where there will be higher and higher treasury yields on the short term.
Okay, and what about our Canadian dollar?
Well, the Canadian dollars, the hands are tied much more for the Bank of Canada governor here because we've already got a pretty weak dollar in the 75-cent compared to the U.S. range, and our economy is not nearly as strong as the U.S. And but while the U.S. was raising rates, the Bank of Canada needed to continue to raise rates in tandem to support that our dollar didn't go any lower. It's down 36% exchange rate or so, and yet our economy is weaker than the U.S., so it doesn't really warrant higher interest rates, and yet you have to go in tandem to defend the currency. And since real estate's been one of the big drivers of the Ontario economy and other parts of the country, it's very interest rate sensitive. So you've got that double whammy of possibly defending the dollar with a higher rate when the economy can't handle it the way that the U.S. can, and also when you've got risk of the real estate sector being so impacted by it. Okay,
so is the Canadian dollar then continuing to suffer weakness because the price of oil continues below $60 at $56.92 at this hour today, and our economy still relies heavily on oil?
Canada still will always and heavily perceived as a petrocurrency, even though we have a much more diversified economy than some other oil producers, which are really even more oil dependent. But internationally, we're still perceived both as a commodity-based currency, like Australia, and also heavily a petrocurrency. So a stronger price of crude would certainly be supportive of a higher dollar.
In the real estate, I mean, prices have started to drop in the major markets across the country in Canada. So is that being perceived as a threat that's materializing in a weaker Canadian dollar?
I don't think at this point, I don't think that link is direct yet, although it's hard to say about the foreign capital flows strictly to real estate, because also our stock market and other factors of foreign money coming in. Remember, at 75 cents to the U.S. dollar for the Canadian currency, it's not great for Canadians who have their core of their net worth in Canadian dollars. But for foreigners, Canada continues to look in some respects like it's on sale. So even as real estate prices gapped up so much in the last few years, and there were extra taxes and fees laid on for foreign buyers, the Canadian dollar went down. And so you got a 36% drop for foreign buyers if they use the U.S. as the reference currency to buying in Canada against some higher fees. So you could argue that foreigners still might find Canadian real estate attractive, but I mean, it's been so overheated, and it's a 20-year bull market beginning in the late 90s.
Sure. To what extent would you concur with the idea that the Canadian real estate market hype has been fueled by Chinese foreign investment that might now see a diminished level of entry into Canada thanks to the problems that the Canadians and Canada and China are having on a macro political basis?
Personally, and I have no specific knowledge of this, but I don't think the attraction of Canada for perhaps Chinese expats to either invest here as a safe haven for real estate investment long term, or possibly to work towards citizenship here through the economic programs that are available federally. I don't think the current spat over the highway Huawei, thank you, situation. I don't think that's material. I don't think that's material at all, in my personal opinion. I think that nobody will really care if they're investors on that front. I mean, that's a very targeted situation, and as long as people, I suppose, don't cross the Americans, I don't think it's a factor.
Right. So what about the tendency towards raising taxes, a foreign buyer's tax on real estate that is not occupied as principal residences that has now been levied in both Vancouver and Toronto? Do you think that's having an influence on real estate prices and the volumes of real estate flow in Canada?
I'm sure at the margin it may have some impact, but if the foreign buyer is people of substantial net worth and they're buying strategically because Canada is an attractive place both to live and to gain residency and other factors, then it's merely just another cost or another fee. And in the big scheme of things, yes, the governments want their piece of this hot market. In the same way that Toronto added a specific tax to localize buyers on top of a provincial tax that existed, a land transfer tax. It caused a little blip in the market. It was deemed to be concerning, but off the market continues. So I really don't think, other than it being an annoyance, I don't think it's going to particularly slow things down. But again, I don't have specific data on that.
Okay, so then let's shift our conversation to gold, which has been strengthening and performing better in the first quarter of 2019 than it has in a number of years. Why is gold starting to look so attractive to so many investors?
Well, I mean, gold is always a question mark in terms of whether it's a long-term store of value, which it seems to be, and an inflation hedge and a crisis hedge and things like that. And if you deem it as a currency in its own right, it's held in okay, but it hasn't been a raging bull market for gold for a long time. But I think what was noteworthy is that recently some charts were published that show that China has been a net buyer, a fairly heavy net buyer in the bullion market since the fall. I'm not sure if it was October or November, and that was after several years of apparently, and it's hard to know if they're truly reporting their accurate activities, but whatever is available showed that they had not been big buyers for several years, or net buyers at all, based on the chart. So the fact that they're stepping in now in the last 3-4 months, month after month, as a big net buyer, that could, and the Chinese are pretty shrewd when it comes to global markets and commodities. That could be a harbinger of a better run in gold here at $1,300. I think it was either Morgan Stanley or Goldman Sachs that recently forecast $1,400 by the end of June. That's a pretty big move from gold perspective, whether that plays out or not. It also links to possible potential weakness in the U.S. dollar, or at least the U.S. dollar not going up. The Fed has now backed out and commented that they're not going to raise the rates forward, and that's all linked together. There was a promise of up to 4 rate increases, which they've now backed away from, probably prudently, and that was leading to a much higher dollar forecast, and that, of course, is negative for all commodities since they're all based in U.S. dollars.
Do you think that other geopolitical sort of turmoil, such as Brexit, such as I mean, even in Canada, the OECD is starting to comment on the situation with the Prime Minister's office and potential allegations of corruption there. But you've got all these other pockets of geopolitical instability that sort of seem to add up to an argument that gold is maybe a safe haven that you want to be looking at right now, at least for some portion of your portfolio.
Yeah, I mean, there's always something on the forefront to be concerned about, but remember that if we view gold as a currency rather than something separate, it's just a currency that you can't buy treasury bills in and get a yield on. Although, if you look at, say, Swiss francs, the short-term, believe it or not, short-term money in Swiss francs has a negative yield. Like a 50 basis point.
You got to pay them to hold the money.
Yeah, so 3 months from now you get less Swiss francs back, but that's because it's the king of currencies. So you could compare gold to that as a flat to negative carry currency as well.
Wow. So it's like paying a subscription fee to know that your pile of money is going to more or less be safe.
Yes, or like in gold, you maybe pay a storage fee at the bank to hold your gold, and that's the cost of holding gold.
Huh.
But I think when you think of currencies and gold as lumped into there, it's always just a relative thing. None of them are necessarily certainly the greatest to own or can be forecast the best to own. Swiss francs have been great lately, but it's a relative thing. So people are looking at the euro versus gold versus the yen versus the pound or the US dollar. So it's always a relative thing, and it's like, which one do I think is going to do better, or which one perhaps do I hate the least? I mean, it's always like that. So tricky. But I think in terms of the Fed having backed away, and they're in a bit of a box because people felt that they were too aggressive in the fall with the rate hikes, and of course the markets certainly reacted very violently on the downside to the rate decision to hike it in December. And it's pretty easy now to say, well, maybe they were too aggressive because the job growth numbers came in a little weak, and the industrial production came in, a little lower than expected, although retail sales were strong. But it can be argued that the economy is going to slow on its own anyway, and that 4.2% kind of spike we saw was a one-off in Q2 in the summer reporting, that people have bought their cars and they bought their appliances, and they don't need to buy cars every year. I mean, sure, some do, but most people don't. So it's argued that it could have slowed down on its own. It didn't need to be hit with the hammer. And then President Trump came out, but every president comes out and criticizes the Fed. It's a constant thing, and they do it here as well, criticize the Bank of Canada. But against that critique, the Fed has made a decision, and now they're kind of perhaps politically in a bit of a box where they say, well, we can't look like we're bending to the president's will, but clearly maybe internally they say we've overshot on the upside and we've caused perhaps too much of a slowdown. But it's clear that the forecasts for GDP growth have slowed in the U.S., not to a negative, but they're not as overheated. So I think there's some crisis, I wouldn't say crisis management, but there's some spinning going on out of the Fed, but it's always the case.
Right. All right, Steve, well, that's great input as per usual. I really appreciate your coming down here today, and we'll have you back soon. Thanks for joining me today.
Absolutely, my pleasure, James. Thank you.